All right, fantastic. Welcome to Coffee with Markus and
Mark.
Okay. Still here in Cancun, Mexico, and we have a fun show today because we're going to talk about what is happening in the markets. This will only take us 2 or 3 minutes, but there's really something interesting happening today, and this is why we also want to show you 3 ways to hedge, because this is a question that came up here during the mastermind. How do I hedge myself against a massive market drop or a market crash? So we'll talk about this. Then we will talk about our current trades and what we did this week, and we'll answer your questions. So pop them into the chat right now, and let's get started because we have a really full show.
This show is about real money and real trades. I'll show you the trading strategies that I personally trade, the tools that I use to trade my own accounts, and we will talk about the right mindset of a trader. Now, talking about mindset, I'm going to show you how to create SRC profits. And SRC stands for systematic, repeatable, and consistent, because that is the key to long-term success in the markets. So, if you are sick of all the hype and empty promises, and you want to learn trading strategies that actually work, then click on like right now and let's get started.
All right, let's get started. Let's start with the first. What's happening in the markets? And we're going to jump over here. Let's see. Yeah, that is the scene that I want to use. And wow, super interesting. Today was the big day. Today, the CPI was released this morning, the consumer price index, and it came in worse than expected. And at first, it seemed that the markets would just shake it off because this is where, let's actually take a look at the futures markets. It gives us a much better picture of what happened here going to the 5-minute chart. So this is where we see this morning, CPI came out, worse than expected. Boom, the market dropped, but then snapped right back. So after we opened, I mean, it looked like, within a few minutes, all of the losses were erased and we're good, right?
Exactly. A real nice recovery with that hotter CPI data and bouncing right back. Things chopped around for a little bit, but that wasn't it.
Yeah, and now in the afternoon, we went for lunch, we came back for lunch, and we thought, whoa, what is going on there? So let's take a look, actually, at the S&P right now, down 1.8%. And I mean, after pretty much being flat earlier, this was a surprise. The NASDAQ down 2.15%, and the Dow being down 1.5%. But I mean, the CPI was not the only thing that's shaking the market. I mean, you looked at 2 stocks where trading was halted.
Yeah, it was interesting to see that Uber was halted. And there was 2 pieces of information here. I guess it was their Investors Day, and it was halted when the CFO was talking. But there was also some information that Merrill Lynch, I believe it was, they has, over the last year, really dropped a large portion of their Uber portfolio, and so now they own only 5%, and that came as a bit of a shock.
Yeah, so Uber down 6%, which was really surprising because this morning after the earnings, where they said, hey, we had the most users ever on our platform, at first they were rocketing higher, and now a big plunge here.
Yeah.
And then the next one is Affirm. On Affirm holding also, we got a trading halt. Right, and so Affirm holding is now down 22%, was down as much as 30% earlier.
Yeah, huge slide. I didn't see or look up news for this one, but I heard that it was halted.
Yeah, so that's super interesting. So we'll see what happens here. So looking at a daily chart also today after reporting earnings, this is when all hell broke loose here. It seems. Okay. All right, but so let's talk about, because this is where I think it's interesting to see how you can hedge against it. And so usually, Mark, I do a quick pause for the editor so that we can, start it fresh. Okay. All right, with all this craziness going on in the market, we want to talk about 3 ways how you can hedge yourself from a market crash. And that's actually where I have my handy-dandy notepad here. So let's just share my screen and let's talk about 3 ways to hedge against the market crash. And one of the first things that people often say is that you can buy calls on the VXX. So let's talk about this for a moment, Mark. And the VIX actually is, let's talk about the VIX. It's the fear gauge of the market.
Sure. So the fear gauge, or the VIX, is based on the S&P 500 option premium, essentially the going 1 month out. So when premiums increase, you have more fear in the market because market participants believe there's going to be more movement in the market, and that sends the VIX higher. So you actually have a VIX futures contract. VXX is a stock or ETF that actually tracks the VIX itself, and so this is something that could be traded both as an ETF or options.
Right, and this is where we see today as the markets are going down, so the Nasdaq is down 2.3%, the VIX is actually jumping up 21%, or if you look at the VXS, it's jumping up 10%. So one of the ideas here is to buy calls, because whenever it is jumping like this, let's just take a look at the Nasdaq. This is when the Nasdaq was going down. It's not only the Nasdaq, it's also the S&P, and it is the Dow. So this is one of the strategies that you can do. So let's take a look at this and see if this makes sense and for whom it makes sense, because you see that we have a spike here. So we want to take a look at options, and we jump over here to an options chain, and this is where we look at the VXX. And so the question is, okay, until when do you want to have your portfolio hedged? And we could just choose 318, which is just a little bit over a month from now. So we look at this, and now we start taking to look at calls and say, okay, let's say we want to protect ourselves when the VIX is jumping above. What do you think would be a good level here? 22?
Sure.
Let's do this. Okay, so just to give you an example, so above 22, and right now the last traded price would be $2.38. Okay, so let's just write this down here. So example, buy 22 calls, expiring 318. So this would be a little bit over a month from now for $2.40. Now, they're trading in 100 packs, so this means that we would have to shell out $240. So this is where the idea is, if the VIX goes up and spikes, we are making money on the calls. However, there are a few disadvantages that I want to write down here. So the disadvantages, and this is where probably we should say what our purpose is. Let's just assume, that you have a $100,000 portfolio, stock portfolio, that you want to protect. So now the question is, how many of these VIX calls should you buy to protect your portfolio, right? So this is where it's super difficult to actually determine the number of option contracts that you need to buy or sell.
Yeah, and here's the thing. Like, even today, it feels like the markets are really falling. They're pulling back, but you look at the spike previously, and we're nowhere near those highs, right? So even if the markets are falling, it could be that the VIX doesn't spike as much as you expect. But also, when you go to buy them, because the markets are falling, you're going to overpay.
Right. The other thing is, as you can see, if you're looking back at the VIX, these spikes, they happen quickly and then they disappear. So timing is very crucial. So in order to cash in, you almost need to watch the markets on a daily basis so that you can cash in on this. And the idea of a hedge is that you say, you know what, I don't want to worry about the markets for the, let's say, next 2, 3, or 4 weeks because you're going on a vacation or you have other things to do, or I don't know, whatever it might be that you're busy, and you just say, I don't want to look at my portfolio. So this is here a huge disadvantage, that you basically need to babysit your options to cash in.
And that's the tricky thing, because when you get that spike, yes, you might be able to profit from the spike, but then you're no longer hedged, right? So instead, you're paying for this kind of pseudo insurance, but then if it pulls back, then it just becomes expensive because you've bought those calls.
Right, because when do you sell them? When it jumps to 27, 28, and what happens if the market crashes as it did, and we're going up to, well, here it was adjusted to 320, but if you're looking at the VIX, right? So if we are seeing usually spikes around 30, and then we have a crash like in May 2022, and it goes up to 70 and 80, suddenly you're no longer protected here. So we should write this down. Okay, so once you cash in, no more protection, or no more hedge, we should say this. Okay, so obviously, as you can see, this is not very good, even though many people say, oh, you just buy some call on the VIX. I think this is the worst way, the absolute worst way to hedge a portfolio.
Yeah, it's my least favorite. I feel that the VIX actually is more efficient than people think. Like, it's priced efficiently, so I really have a hard time trading volatility products.
Right. Okay, so the next is, this is where some people say, well, just buy some puts on a contract like the SPY, for example. So the SPY, let's just jump over here and show you what that is. So the SPY is also an ETF that is kind of mirroring the S&P 500.
Yep.
The advantage is it's not as expensive as this. It's only like the SPY is approximately a tenth of this. Okay, now you can say, cool, let's do this. Let's get some downside protection in the market here. And where do you want to protect? Where should we protect ourselves? At 440, if the market drops down to 440? Sure. Let's put a horizontal line in there so that you get the idea. Okay, and we take a look at this. Let's just go back here, write it down, buy puts on the SPY. And here we have another example. And so the example is that we would, let me just scroll up here, buy 440 puts expiring 3/18. So this would be in 1 month from now. Actually, 1 month is without the S at the end. Okay, so let's see how much this would cost us. So we're looking here at the symbol is the SPY. We're choosing the same expiration, so we're going out to 3/18 to give us approximately a month. Let's just look here at the, what did we say? Where did we want to
440?
440. Okay. So the 440 put, we have a last traded price here. Probably need to zoom out so that we see it better, of $9. Wow, $9.07, but let's just round up here to $9. So this would cost us $9 per option, and that sounds fairly expensive. So let's talk about the advantages first. For the advantages, it is fairly easy to calculate how many contracts we need to protect our $100,000 portfolio. Because if we would trade 2 option contracts, right, with this we have what, 88,000 protected, which is kind of,
yeah, because one option contract with the price of $440 per share times 100, it's 44,000. You multiply by 2, that gives you 88.
Okay, so that's not bad at all. So let's talk about the disadvantages. And the disadvantages is that we have a pretty expensive insurance.
Yeah.
So let's talk about why is this so expensive? Well, again, we need to buy 2 440 puts for $900 each. So the cost of this hedge is $1,800. So this also means that to the downside protection, your break even is actually $9 lower here than the 440.
Yep,
so it drops down to
431.
331.
431.
431. Yeah. Okay. Yeah. Plus, and also, here's the deal. Also to the upside. So this means that right now the stock has to move, or the SPY has to move $9 higher for you to actually make money, to make back the cost of these options here. So this is important to understand.
Yeah, so the idea here is if you have a portfolio that is loosely tracking the S&P 500, right? If it's basically mimicking the overall market, the S&P 500 is a good proxy for the U.S. markets. And when you buy those puts, they're expensive because the market has dropped a little bit, so you're paying a lot. And for you to offset that hedge, like you said, that portfolio would need to go up to offset that expense. And for you to really be making money, it needs to drop some. It needs to drop some.
Yeah. So if it doesn't drop below 431, you're not making any money on the puts. Okay. So that doesn't sound very efficient. Okay, so far we're not off to a good start, but I think it is super important that you understand your different options, pun intended here, so that you know when somebody just said, oh, you just buy puts. It's not that easy, or you just buy calls on the VIX.
And here's the thing, this would be the cheapest option, in my opinion, to try and get insurance, right? But I think that the trickiest thing here is we just went out a month. If we went out 6 months, it's going to be way more expensive. And think of all the times when the market isn't falling, right? So if you're trying to hedge yourself and you're just paying that 1,800, quick, all of a sudden you're out $10,000, 10%.
Okay, now before we go to the third thing, I think it also might make sense to look up, well, what is the definition of a hedge? What exactly we are talking here? We're not talking about protecting yourself, we are talking about hedging yourself. And I looked it up. Oh no, this was the wrong okay. Over the edge, you probably know this. Okay, so let's talk about this definition here. That we see a hedge is an investment that is made with the intention of reducing the risk of adverse price movements in an asset. And this is where we see here normally, and let's just copy this over here from Investopedia. So thanks Investopedia for letting us know. Normally, borrow this. Normally a hedge consists of taking an offsetting or opposite position in a related security. And now we're getting somewhere. Okay, so let's talk about the third possibility, and this is buy an inverse ETF. Ooh, okay. What does this mean, Mark? So let's talk about this.
Sure. So you have ETFs that mimic the different indices. So you have an ETF that tracks the Dow, the NASDAQ, the S&P 500, the Russell, and those are going to be ETFs that move with the index just like the SPY. Right. But an inverse ETF actually moves in the opposite direction. So if the S&P 500 is going up, the inverse ETF is going down. You're losing money if you've bought shares of the ETF. But if the S&P 500 is falling, the inverse ETF is actually making money and increasing if you've bought shares.
All right, so I'm just writing down the regular ones that are tracking these indices.
Yep.
And now let's talk about the reverse ETFs. And let's actually go in the same order. Let's take a look at the one for the Dow. Let's just say you have a stock portfolio that mainly consists of value stocks that you typically find in the Dow. So what would be possible solutions here, Mark?
The ticker is DOG. And so this is going to move in the exact opposite of the Dow.
Dog.
Yep.
DOG. Okay, so let's take a look at this first before we give you the other ticker symbol. So if you're looking here at, no, not at the Dow, the DJI, here we go. This is what the Dow looks like right now. So if we look at the dog, it moves the exact opposite. Okay, so that's super interesting and trading at 32.60. Cool. So let's talk about the next one.
And I think, actually go back there real quick. So if you look at the percent move, I think that's the most revealing, because with these inverse ETFs, there are some management fees and they're balancing it daily. So one warning here, I would not do this for a long-term trade, because it's not going to mimic it perfectly long-term, but for a short-term trade, it can be a great hedge.
Right, exactly. Okay, so this is, for example, for the Dow. Let's jump over and let's say, okay, for the S&P 500, what if you wanted to protect, what if you have a portfolio that kind of mimics the S&P 500?
The inverse ETF would be SH.
SH. Okay, interesting. So we can also take a very quick look at this because then we show you something really, really cool. So SH, again, if you look at the S&P 500 today, down 2.18%. This one exactly up 2.18%.
Exactly.
So it doesn't get any better. Okay, so let's also talk about for the NASDAQ. And which one would that be?
With the NASDAQ, it would be PSQ, would be the opposite.
Okay, so
or inverse.
PSQ would be, not the reverse, the inverse. I should say the inverse ETF. Okay, good. So here is a problem. So the disadvantage of this is if you buy those, you have to tie up a lot of buying power. So if you have a $100,000 portfolio and you want to protect yourself, you have to buy $100,000 worth of DOG, SH, or PSQ. So this is where the downside is require a lot of buying power, and you might not have this buying power in your portfolio. You might actually tap into margin to do this, or you might say, I don't have this. And this is where we want to show you something really, really cool. So Mark, let's talk about what would be, in our opinion, the best way if you are planning to hedge a portfolio.
And this would be what's known as a leveraged ETF, and in this case, it would be a leveraged inverse ETF. And so you might have heard us say we do not like to trade these with the wheel, and that's for a reason, because they're magnifying gains and losses. But for a hedge, it actually is a useful tool for someone that doesn't want to close positions but wants to manage their risk if something's going on short term.
All right, fantastic. So let's take a look at some of those, and let's get started again with the Dow. So what would be a leveraged one for the Dow?
So 2 times the movement in the Dow would be DDM.
DDM.
And then 3 times the movement would be UDOW, UDOW.
UDOW. Okay, now let's take a look at UDOW. Let's get started with this one. So UDOW is actually right now, today, losing. Is that correct? You have the wrong one.
I apologize. I looked at my notes wrong. It was SDOW, not UDOW.
SDOW. Okay, there we go.
And you want to check.
You want to check. You want to check because okay, this should be going down.
Marcus, you need to check the other one too.
Okay, we will.
Okay.
So
that looks better.
SDOW, exactly. So the Dow Jones is down 1.81%, and this one is up 5.31%. So let's just see. So we have what 5.31 divided by 3. It's 1.77, and as you can see, it's changing here all the time. Sure. Okay. So what do you want me to check? The other one?
I just want to make sure that the other one's DXD. I think I gave you the wrong one.
DXD?
For the 2X.
Okay, good.
On your notes.
On my notes. So let's do this. So let's just talk about this, of why this makes a lot of sense before we give you the ones for the S&P and the NASDAQ. Because especially if you take a 3 times leverage, as you can see, that's where we go back here to SDOW, right? You basically only need a third of the buying power because it moves 3 times as much.
Yeah, so if you have a portfolio that's a little more value oriented, and you're looking at your portfolio and you see that when you have up days, it's really mimicking the movement in the Dow, then this is where you can buy shares in $33,000 worth instead of the $100,000, but you're going to get a real nice inverse move, making money on the SDOW while you're losing money on your portfolio, but hedging and balancing it out.
All right, so let's take a look at the other ones really quick, and then we tell you the advantages and disadvantages of this approach. So the 2X for the S&P?
The 2X for the S&P is SDS.
SDS. And the 3X?
SPXU.
SPXU. Okay, and for the NASDAQ, if you have a portfolio that consists mainly of value stocks or tech stocks?
For the NASDAQ, it's QID for 2X.
Okay.
And it's SQQQ for 3X.
SQQQ for 3X. Okay, so let's talk about the advantages. So here with the leveraged inverse ETF, the advantage is it requires only 1/3 of the buying power. Another advantage is that you can protect your whole portfolio. Exactly. So there's no guessing, because if you have, for example, let's say that you want to protect it with the SDOW, and you have a $100,000 portfolio, then you just take the 100,000, right, divided by 3, because this moves 3 times as much. So it's 30,333, and divided by the current price here, 28.24, and you see that you need to buy exactly 1,180 shares. Boom! I mean, this way you have an exact one-to-one protection. So this, I think, is a huge advantage. But let's talk about the disadvantage. The disadvantage, and I almost don't want to call it this way, so I'm putting this in quotation marks, and here's why. The disadvantage, it is a full hedge. What does it mean? A full hedge means that if the Dow moves higher, the SDOW moves lower, and you lose money on the SDOW while you're making this. So it's basically a net zero. So you don't really have protection, you have a full hedge. When does a full hedge make sense? Let's say you have some exposure to the markets and you know that for the next few days or for the next few weeks, You cannot look at the markets at all, and you want to avoid that the market crashes and that you get caught on the bad side. You just want to make sure that your portfolio's value stays exactly where it is right now. That's when a full hedge makes sense. And this is the other thing here. It is super easy. That's not a disadvantage. It's an advantage. Easy to put on and off. And other than with options that we have earlier, you don't have to worry about a time frame. You can do this for a day. You can do this for 3 days, 5 days. It doesn't really matter. So doesn't require a time frame.
And there could be some issues with longer term, time frames, but that wouldn't be. There'd be no point to hedge your portfolio for 6 months. Right. Like this is all weeks, maybe a month, but long term, it wouldn't make any sense to do this.
Yeah. So as you can see, first of all, you need to understand that there's two things. There's a protection from a market crash. This is where, if you go back here, a protection from a market crash would be, for example, with buying calls on the VIX or buying puts on the SPY. If this is something like today, where the CPI number was released, and you're worried about that the market could tank, you can put these trades on and kind of babysitting them. But if you truly want to hedge your portfolio, meaning that you're removing all of the risks right now, both to the upside and the downside, and you say, you know what, where my portfolio is right now, that's where I want to pick off, then we believe that buying an inverse ETF and buying leveraged inverse ETFs should actually make this here a heading. Yeah, that this might be the best thing that you can do to fully protect yourself.
And the nice thing is, for those of you who understand options, there's no volatility crush, right? So this is where you are hedged if there is a drop. But like with CPI, it could be that with options, they priced in a bigger drop, so you think you're making money or having it offset, and you're really not because of the way options are priced. So this would be the ideal way to do it.
Okay, so now you know 3 ways how to hedge your portfolio against a market crash. And if you find this helpful, click on like and subscribe to this channel. Hit the little notification bell. This way get notified whenever we release a new video. And take a look at these videos that should be popping up right now. And we'll see you in the next one. And cut. We're still here. Just kidding. Okay, so let's actually take a look at some of the questions here before we talk about our position. So we still have some time here. And Claire said it. The market treated us well today. It actually did. It actually did. Okay, Steve from Australia. So good to see you here. Maggie, hopefully you can join us in Germany. This is where we have the next live boardroom. Super cool, interested in this. Okay, so let's see what is happening here. So Anatsky said, so hedge, buy puts when your short puts get tested. You see, this is why we wanted to do this, because often there are these advice, just buy puts or just buy calls on the VIX. And I think it was important to just show the difference so that you know the advantages and disadvantages and can decide of what would work best for me. And Dan said it, today's markets are up and down like a roller coaster. Kind of crazy here. So Derek had his question mark on for you. Where did you find the news about the stocks that are halted?
Actually, I first saw it with a mastermind member posting the question in the mastermind group, and then I looked into it. Yeah. So it was brought up by a mastermind member.
Okay, and one of the things where you like to go is actually Twitter.
Right? Yep, I do not use Twitter. Except I do find that for breaking news, it actually is a good source. And that's where I got that information on Uber.
Yeah. All right, so John says, expensive, and one can predict the timing. That's probably for the calls on the VIX. John, you're absolutely right here. And Edward says, feel that Putin is likely to invade Ukraine sometime after the Olympic, puts on the SPY. Well, this is where, again, if you right now don't want to have any exposure to the upside and the downside, you can just buy a leveraged ETF. If you say you want to have, that's another thing that we should have mentioned probably. If you want to have a limited protection to the downside, where you say, you know what, I want to protect maybe half of my portfolio, you just buy fewer shares that are protecting you to the downside. This way, You're still protecting on an upside move, but you have some protection to the downside. Which means, for example, if you're protecting half of your portfolio and the market crashes by 30%, your portfolio would only be decreased by 15%. So you you're basically taking a little bit of the volatility here out of the markets. And yeah, Natsuki says it. How about buying inverse ETFs? You are good. Okay. All right. So let's see. What other questions do we have here? Okay, if you want to protect a stock, could you use a collar option? Again, so there's the deal. Yes, you can always use options. And keep in mind, when you buy options, and even if you put on a collar here, right, you are actually doing it usually at a debit. And by doing so, you just need to know that this is kind of the insurance that you're buying, and this is the premium that you're buying here.
Yeah, and with a collar, what is it? You're selling calls to pay for the puts, right? But then if there is upside, then your upside is limited, right? And you know, it just gets a little messy. I like the inverse ETF idea.
Yeah, that's actually the simplest one. Okay, so if you have any more questions, pop them in the chat here. But let's actually take a look at some of the trades that we did here this week. Let's actually take a look at all of our positions that we are in. And so for me, as you know, right now, I have the Tastyworks account that I'm winding down, and then we also have the Tradier account. So we'll take a look at the positions in the Tastyworks account first. And the first one here that we have is ARCF. And that actually what was really fun to trade, because what we did here a few days ago, we sold the 28 puts. And this would be for the first rescue mission. And just want to see if I can quickly bring in a horizontal line here. Boom, there we go. It's almost at 28. And as you can see, after we did this, ARCF moved higher. So right now, if ARCF stays above 28 by tomorrow, because tomorrow is when it expires, we just keep the full premium there. All right, so this is what we did here. LVS, that is another fun one. I mean, yeah. This is, it's right now trading at our cost basis. So this is why right here, we have been selling calls, and this has been working really well. So we did sell some calls last week, and then today we rolled these calls. So what does it mean? We sold the 47 calls for this week that expire tomorrow. But this is where we said, let's have some more fun with LVS.
Yeah.
I mean, we have been, as you know, we have been in this LVS trade for quite a while. And this is why we said today, you know what, let's just absolutely sell a few more. And so we rolled it into next week. So we bought back the calls that are expiring tomorrow, and we sold the one for next week. And by doing so, we made how much?
$1,820.
$1,820. Let me just see if I can quickly show you of what has been happening here in LVS. Because this is where it was fun to bring in some more premium here. Let's see. I just want to see before we move on.
Yeah, because LVS was one of those trades where we sold puts and sold calls for a couple of weeks, and then it dropped. So we did fly one of those rescue missions, and we've been in the trade for a while, put on a couple of trades, and now it's right back above our cost basis. And nice to be making some money on it.
Yeah. I don't know why I can't slide this in here. I might have to... Let me just see what I need to do that I can slide this in. Ah! There we go. That makes more sense. Okay. So here we go. Let me just show you the account. So for LVS... now, get back here. We have been able to add some more premium today, now for a total of $13,333 in premium. So this is actually looking pretty good. Okay, Mark, let's see, what else did we do? Oh no, let's take a look at the last one here that we have in this account, sharing my screen again. And this is right, and nothing yet to do. I mean, right, super interesting. I mean, it seems to, if you look just a little bit at some technicals, so we seem to find some higher lows here, but we also have still this resistance kind of somewhere there. So we'll see. This will be interesting to see over the next few days if we have a break to the upside, and you know that right is the trade. That I'll be in the longer term.
Yep.
So, Okay, let me just remove this because otherwise when I bring it up the next time I say, what the heck did I do? So let's talk about the trades that are now in the Tradier account, and one of them being ADI. And ADI actually has been very fascinating. So for ADI, we sold the 162.50 put.
Yep.
Let me see if I can mark it here on the chart. It never works exactly how I want it to be, so this is why I'm correcting it here. 162.50, and this is where we were able to collect premium on the puts. Then we were able to sell some calls, then we were able to buy back the calls, then we were selling some more calls, and this is where if tomorrow ADI closes above 162.50, we get called away, don't make any money on the stock, but keep a ton of premium that we made on trading the options. If it stays below 162.50, then we have this and can sell more calls.
Yeah, my break even is 155.42, so some protection.
Mine is somewhere around there,
Yep.
around 155, so we're good there. Okay, let me remove this line. So we didn't do anything this, did we roll anything this week? No, we did not.
No, not on
Okay.
ADI.
And then we have CLF. So
Yep.
CLF, this is where we actually got assigned at 20. So we sold a little bit earlier here some puts at 20, got assigned, so we own CLF. And then as you can see, it was moving higher. We sold calls. And this is where, right now looking good. If this stays above 20, we get called away, just receive a ton of premium for when we sold puts and calls here. And we shall see.
Yeah, they do have earnings tomorrow. My break even is 17.87, and yours is probably pretty close.
Yeah. Okay, so nothing to do here. We have no roll, so we expire either tomorrow. Maybe we do a roll tomorrow. Let's just see what the markets are doing tomorrow. Okay, and then IWM, super, super fun. IWN, I was assigned at 205. So let me draw the horizontal line here. So 205. Boom, there we go. So we sold some puts, then we got assigned, sold some calls, bought them back, sold some calls, bought them back, sold some more calls, and now let's see, maybe we can buy them back if IWM closes above 205. We're getting called away. If it does below, we just keep selling calls and keep collecting premium. Kind of like that.
Yeah.
Okay, and then we had a new one today.
We did. DHI.
Okay, so we saw this morning. As the market was going down, we were looking at DHI, and we did sell the 83, right?
Yep.
Okay, so let me bring in a horizontal line here. And this is for next week. So the 83 put for next week, we collected 70 cents. So that's pretty good. And now if DHI, DR Horton, stays above 83 by next week, we just collect the premium. If it is below, then we will get assigned, and we do the same thing that we have been doing, where we had just a fantastic January. And I mean, February is pretty good thus far. I mean, premium has been fun to trade. This volatility is great.
I'd agree.
Okay.
I'd agree.
All right, so these are the trades that we have on right now. So the 3 in the Tastyworks account, the 4 that I have here right now in the Tradier account. So let's just see if there are a few more questions that we can answer for you here before we hit the beach.
Yeah.
Okay, CRCR from Ireland. So good to see you. Your thoughts on leap calls on Sense? I don't even know what Sense is. Don't know. Are you aware of Sense?
Yeah.
I don't like leap calls. They're just horribly expensive. I mean, I think that leap calls are a good idea if you don't want to own the stock, right? That you have a replacement. Instead of buying the stock, you could buy a leap, right? Because the time decay is not that much. So,
yeah, I mean, here, I think it's hard enough to figure out what's going to happen 2 weeks from now, let alone a year or so, and it looks like it's less than $5. Not really the type of stock we trade.
No, we don't like this one. So Eduardo says, why not use call trade spreads on the inverse leveraged instruments? Here's why, because my head starts spinning if I just think about it. I mean, Eduardo, and again, you might be so much smarter than me because I'm not that smart. For me, I need to keep it simple. Now, if I think, okay, let's see, if the Dow goes up, then also the SDAO or whatever we had there goes up, right? So you can look up the ETF. And now I'm doing a call credit spread on this, and this
You'd have to figure out what your risk is on that. Yeah, it gets messy. It gets messy.
And I'm not saying, Eduardo, here's also one other using a put credit spread with leveraged inverse ETFs. Not saying that it is not a good idea. For me personally, I think I would mess it up.
Yeah, it seems like you're thinking more about making money in that situation rather than creating a hedge. You could create a hedge, but there are definitely more steps involved.
Yeah. Augie says a little bit of thud noise from the microphone being on the table.
I'm doing that. I'm sorry.
Well,
I get too excited.
Mark has to tap on the table. Yeah, and I mean, as you can see, we're not in our studio, so we will fly back this weekend, and next week we'll be back in our studios. So very cool there. Eduardo is asking, what app or software do you use for broadcasting? I'm using it on the Mac. It is called eCam Live. eCam like eCamera Live. That's the software that we are using here. All right, Ben says, very informative. Thanks for keeping me up to date. Cool, there you go. Okay, Rick is asking, does a roll-up ever make more sense than closing a position and opening a new one? Or is it essentially the same? Rick, you're right. It is exactly the same, because what a roll means, it's just a fancy word of buying back the option that you sold earlier and selling a new one. So the way is sometimes you can do this as a complex order with your broker so that you don't do it manually. Well, what you could do is you could right away just buy back the call that you have sold earlier, sell a new one, or you tell your broker, do both at the same time, right? And this is a complex order, and this is meant by rolling. So basically you tell your broker, you did that for me.
And the thing is when you do it manually, if you're quick and you're good and you know what you're doing, you might be able to get a better price, but if the market starts to get away from you, it could be that you get worse. When you do it with your broker as a multi-leg order, it's just on autopilot and it's simple.
Okay, good. All right, so we have one more question here that I think is good. AC Bonwell says, when you start looking at something that took a big drop like Facebook or PayPal, we talked about it this week, especially Facebook, right? So let's just bring up the chart for a moment so that you see what is happening here in Facebook. If you have not been following the market, Facebook just has been dropping. So they reported that they have less DAU, daily active users, and that they have trouble with the privacy update from Apple, where right now advertisers are struggling to be able to track you. And you know that Facebook is big about tracking whatever you do, right? So this is why, I mean, they used to be a $1 trillion company. Right now they're at $620 billion. So I mean, really $300+ billion got wiped out in this. So now the question is, okay, why wouldn't we buy this? Why wouldn't we jump on this? And this is where I think, see, AC Bonwell, Facebook has actually admitted we're struggling. We are losing users to Snapchat. We are losing users to TikTok. And now you look at this chart again, and now you're looking at Snapchat. And Snapchat, boom, huge move. Was it a 20% move? We could quickly measure it here, right? So from this close to here, oh my gosh, this is a 40% move. A 40% move. So Snapchat is kind of stealing the thunder from Facebook right now. Now, Facebook already addressed it and said, oh, no problem. We will actually go into the metaverse. But this is where investors said, well, that's cool that you're rebranding yourself to Meta, and what does that mean, right? I mean, you haven't shown anything during the earnings call where you said, hey, we are investing in this, we have bought companies or something like this. You just said that your name is now Meta. So why am I saying this, AC Bonwell? Especially when you're trying to buy a stock like this, you want to make sure, is this still a solid stock? And Facebook has been making some really nice profits in the past, and now it seems that they start struggling.
Yeah, and this is where our wheel scanner and PowerX Optimizer was identifying the 205, the 210 puts that we could sell, and it was tempting, don't get me wrong, but I just felt there were safer trades out there, and that's what we were looking at.
Right. I don't even know what I'm bringing up here, why it says still Markus, Heitkoetter, Markus. I think, no, I'm just playing around with stuff here. Okay, don't worry about it. So let me come back here. And so this is where Webby Wonder says, same question as AC Bonwell, AFRM tumbled today on results. Yeah, and this is where, look a little bit behind the curtain. So let's actually show you one more. And okay, no. So it is what it is. It says Markus Heitkoetter, it's even both.
That's all right.
So let's take a look at a firm. AFRM. Actually, no, I want to go back to Netflix.
Oh,
here's
okay.
why. So here's why. So Netflix, as you can see, is still struggling because Netflix recently in an earnings call said, we are not gaining subscribers as quickly as possible. And everybody thought, oh, that's not good for Netflix. But then Netflix kind of bounced back because everybody thought, oh, that's normal. The pandemic is kind of over and people are not watching Netflix all day long, or I don't know, something like this, right? But then Disney came out today and said, we're crushing it. I mean, we're just gaining subscribers left and right. So this is where I think it's very important, Webby Wonder, since you said AFRM. I didn't look at why they tumbled today, but you need to look behind the curtain and say, okay, is this company in trouble? Somebody, an analyst recently said that the Netflix business model is dead. The Netflix has to change the business model. Now, I don't think that this is true, and I just read it, and it might have been an analyst who has no pull at all, but I think it was from a more reputable company.
Sure.
And this is where these analysts are being paid a lot of money, and they usually work in teams, and they know the Netflix subscription model way better than we do. And this is where I would say, okay, be careful and don't try to catch a falling knife, because this is one of the things that might have happened to some recently who got into Peloton, where after Peloton had this huge drop, they might have said, oh, now there's a buying opportunity. I can buy Peloton much cheaper.
PayPal is a great example too.
Yeah, PYPL. I don't understand why they're still falling.
I know, but it's a perfect example because that first slide was because of the Pinterest news, and it seemed like that was ridiculous. But if you were to just trade it because you thought it wasn't a big deal, it didn't stop sliding. Right, it kept going lower and lower, and then there was earnings 2 quarters ago.
Yeah.
So, yeah.
Anyhow, hey, it's time for us to really hit the beach. Seriously, love hanging out with you. If you want to hang out with us again, click on like and click on subscribe or watch any of the videos that might be popping up somehow, somewhere here. And have a great rest of your day. No stock market update tomorrow. We'll see you back on Monday.
Happy trading, everybody.